I'm going to do it. Um, wow, ladies and gentlemen, global macro traders. Maybe that's how I should start this show. Or maybe it should be with a poem. Because markets, what do markets do? Well, for me, they whisper secrets in my ear. I hear gold dreaming. I hear Bitcoin scheming. The Treasury, my God, there are deficits divine. A comedy, it may be. The Feds in costume, pretending it's fine. Me, I'm Hugh Hendry. I'm your friendly ghost of cash and calamity. Welcome, my dear friends. Friday, it's the end of the week. We made it again, and this is my third, even 3 dishes, and I'm worn out. Welcome to the Acid Capitalist, where logic, I hope where logic melts, where decimal points are banned, and money hallucinates. So we're going to say goodbye to October. And what a month, another up month, lots of up months for equities. And I would say over the course, am I speaking rapidly? I should have a sign, slow down, slow down. Over the course of a month, we survived a month with no government. Imagine. What did John Lennon sing? Imagine there's no government. No hell below us. The economic landscape, we're guessing. We're flying blind. It's glorious. 3 words, I think, maybe signed. 3 words. Maybe 3 words. Maybe 3 words. Forgive me, I was hesitating there. I was thinking I'd messed up my camera. 3 words for the month of November. I was going to say nada, but that's with an A. Nada? Let's call it nut. No, what? Where'd the N come from? Anticipation. The month was spent anticipating Fed rate cuts. I mean, maybe that was the first week or so. It became a foregone conclusion, and we got it. 25 basis points. Disruption, my friends, the government. And resilience. I mean, I'm still staggered by the Caterpillar earnings and the $1 billion. It's not miss, positive, inverse, negative miss. They beat estimates, quarterly estimates by $1 billion. And of course, Amazon. I mean, gigantic $1 trillion companies up 12% in a day. Do you know what I call that? I call that resilience. Yesterday, this is Friday, yesterday, the Thursday, we were supposed to get the third quarter GDP, or key indicator. And you know what? I didn't even know it was on the calendar. I was like oblivious, except that critical data point. Would you believe? Like many others, it was not released. And yet here we are. I said, breath, people. Breath, breathing. We're breathing. We survived. We survived a month without knowing. They said it was impossible. We made it possible. But, so GDP, our friends at the regional feds, they give us, this is a kind of new thing. It's kind of fun. It's kind of like a quiz show. But the Atlanta Fed, GDP now, that model is estimating almost 4% for the third quarter. Now, that's an annualized. That's quarter over quarter annualized. But the Atlanta boys, consumer spending is still. Did I mention Amazon? Amazon, of course, the surprise was on the AWS? Data centers and cloud. But Atlanta, almost 4% annualized growth. Fed's cutting interest rates. And the New York Fed, they get in on the act as well. Their nowcast is at 2.4, so quite a difference. But they do tend to deviate models, and they come together. That deviation is actually, it's not larger than the historic spread. Maybe the Atlanta Fed is more reliable, but only just. So we didn't get the GDP. So let's talk about facts. So first quarter real GDP was down 0.5%. And I think this will be quarter on quarter annualized growth figures. It is. The second quarter, 3.3. Now, and of course, the third quarter estimates seem to be somewhere around 2-3%, I think. But that first quarter, minus 0.5, a contraction. If you actually measured gross domestic and you didn't net out for exports, imports, and so you didn't capture the importation of a lot of goods to beat the tariffs, and if you didn't measure the drawing inventories down, then the gross final sales to private Americans was up about 3%. So it just feels like this is a 3% handle year that's going to be given a 2% handle. Should I say something about why they contract? So surging imports is income that is leaving the United States and going to China, et al. So that's a drag on GDP. And inventories, if they're drawing down, then imagine the opposite, that you're building things and they're not being sold, but you're building it, and so there's incomes, expenditure involved. So it's the opposite when they fall. Today, economic data. What did we get? Today, Friday, 31st. I mean, they should have given us like oh yeah, like maybe they did phantom data. Just, I'm not telling you about any phantom data. I've done that. No more phantom data. S&P, I believe, up almost 2.5% for the month. I believe that was the 6th consecutive monthly gain, coming off that really meaty sell-off in springtime. The Nasdaq, again, 6th consecutive month higher, but up, in fact, 7 months actually, but up more like 5%. 5%. Did I say Amazon was up 13? I think maybe 11. I've been talking about cats in boxes, and so forgive me, but I couldn't resist. We talk about Z-scores, so stocks which are moving beyond the average variance, so they're proving spikier, either up or down. So Amazon up 11%, that'd be probably a Z-score of 2 or so, 2 or 3 maybe. It's unusual. A day like that, has an occurrence of maybe every 1 to 3, every 1 day within 3 to 5 year time periods. I'm making this up. I want to talk about international paper. It plunged. Sound like a stockbroker. Mr. Hendry, your stock plunged. What? Down 12%. And I thought, interesting. Container board. The raw material for those corrugated cardboard boxes. And of course, it was happening on the same day as we had Amazon's results. And Amazon's always got booming package volume. And is it just me? But when I get an Amazon delivery, my allegation, overpacked. Oh, like just, I'm like, really? It feels like a real waste. But that's a lot of corrugated cardboard. So what's going on with the container board companies? And so I did not think I would be spending a Friday night discussing corrugated paper. And in fact, I am doing this. I've gone to Mike before 8 o'clock in the evening. Am I organized? I'm not sure. Am I benefiting from a full night's sleep? Yes, albeit there were Brazilians next door to me who had a party. It's a rather cool party. DJ et al. To 4 in the morning. Amazing lightscape, lighting up the sky. And me, I was just like, no, I'm going to sleep. Listen to a long thing about the Divine Comedy. Is that daunting? Must look it up. Anyway, I've got George Gammon. He just arrived, and I'm going to have dinner with George at 9, so I'm hoping I can wrap this up. So I should stop talking. Paper, corrugated paper, what's going on? Well, the industry's been struggling with less and less shipments. You've had mill closures. Why? Well, during the pandemic, there was a surge, everyone at home, ordering online. But since then, Amazon's really made a big, have they made a big effort? Am I the last person to see the big effort? Apparently they've adopted lightweight mailboxes, flexible pouches, right? They're right sizing, it's right sizing the packaging. Sounds a lot of baloney. All I get is a traditional cardboard box with like a big box with a toothbrush inside it. I don't order toothbrushes, forgive me. But yeah, there was a statistic. There was a cat in the box. What did I read? What was it? I think I read that the per person box consumption. That's not people in boxes. That is the number of boxes consumed by each person. And I'm annoyed. I don't know actually the actual number of boxes. That'd be interesting. But it's 20% below its 1999 peak. I mean, wow. Like, that's 26 years ago per person. Like, can that be right? Am I the only one that thinks that's bullshit? The cat in the box. US box shipments have slumped to the lowest level since 2016. The FBA, the Fiber Box Association. Can we stop talking about boxes? The weakest second quarter figures since 2015. It's a bloodbath. It's a bloodbath. I read somewhere, where did I read this? It has nothing to do with international paper, but it's coming into my mind. Bad times create good people. Kind of sounds right. Churchill. How good a person was Churchill, but when there were bad times, he was a good guy. Agree, disagree. Good people create good times. I think that's about right. It's reflexive. Being good is reflexive. Let me good people create good times. Oh, no. Good people. Good people create good times. Here's a new one for you. Good times create bad people. That's very normative, isn't it? Oh, you bad person. And bad people create bad times. Oh. Let's try and put that into international paper. Oh, can we stop talking about paper? No, we're going to finish this section. Let's start with good people create. Now, let's start with good times create bad people. So I guess we'd have to go back to pre-1999. And you've got this explosion. Jesus, pre-1999. That is an astonishing. I joined my first hedge fund in April 1999. That's a long time ago, really. And I do recall having I think we were buying Stora Enso. Were we buying Stora Enso? And then they made a all paper deal, and it was a turkey. It was a bad deal, and I was really annoyed. And I met the management, and I was not a pleasant person. Was a good person in a bad time. Anyway, good times create bad people. So, but back then, they would have been gearing up. This is kind of like an analogy for the AI in the data centers. They'd be, hey, Amazon, we're going to be, people are not going to be going to the high street. They're going to be ordering things that's to be delivered to their home. And I can invest. So I've got to build, what have I got to do? I've got to build capacity. It's coming, it's a certainty, and it's correct. Good times. That's the good times. But they overcommit. They overcommit. And that's that creates the, and now we're in the bad times, and is it the bad people? I hate that term bad, but the misjudgment of the demand. I mean, I'm finding myself still struggling to understand the demand and how it's not come through with the rise of Amazon. Again, thought bubble, but did I read that Amazon is the second largest employer in the US? 1 point something million people. Quite amazing for a digital WWW, the poster child stock of Y2K. 25 years later is the biggest employer of people in the US. Go figure. Okay, bad apples, bad people, bad times, paper, put it to rest. But one of an analogy with artificial intelligence that probably doesn't exist. But what really hurt international paper was a big part of their. So they reported losses, and a big, largely that loss was an accounting loss. And actually, as I say that, let me share with you another story. As you probably know, I was saying the other night, I went to Strathclyde, my university. It's not Harvard, it's not Oxford, it's not Cambridge. I was an experiment. I was a diversity candidate. Bring a poor kid in from a shitty university. And as a poor kid, my aspiration was just to get not just, but like my father was a truck driver, so like what's the pay grade above the truck driver? So I was aiming. The stars that I were aiming for were in accountancy. And I studied accountancy and economics for 3 years. And then in my 4th year, I discovered this subject called market-based accounting research. And I sat there. I tell you, I sat there with, you can imagine, a monstrously old computer, black screen with a green font. And I was conducting accountancy studies and trying to test the intelligence or lack of in market pricing. And so we would take a subsector of companies that were producing earnings releases like international paper, where there was a change in the accounting policy which had no effect on the recurring cash flow of the business. And then theoretically, if the recurring cash flow of the business is unchanged, then the stock reaction, even if you're announcing a reduction in earnings, the market should see through that. And so you take 1,000 companies, if you will, you would analyze like a bit like Z-scores. You have a recognition of what normal trading would be in terms of daily price movements, both 90 days before the announcement and 90 days afterwards. So you could define normal, and then you'd introduce these shocks. And one shock would have no significance for cash flow. One shock would have significance for the cash flow of the business. And the question was, would the market be wise enough to sort it out? And the answer is yes, the market is kind of smart. So if you're raising your depreciation policy, so you're deciding to reduce the useful life of the assets, no impact on profits, share price should be kind of unchanged. In international paper's case today, They went one step further and they were actually writing down the value of the asset. So what they were kind of reducing the estimated useful life, and they were also reducing the expectation of the return on that investment. They're like, we built this plant in 1999. We thought it was going to have a 50-year life. We thought we were going to make $1 billion in revenue from this plant. Turns out we were wrong. Oops, we're writing it down. Stock price cratered today on that because that would have cash flow implications. The historic cash flow, they overcommitted, so it was a cash negative, but the importance for the share price was that the management are telling you, yeah, our return on investment assumptions mean that implicitly we're telling you that the cash flow in the future is going to be less. That's what we're seeing. Bad times and we need good people. So the good people are like biting the bullet and closing down the capacity, and then we'll get a new cycle. But we're in the cycle just now, which is nasty. Now, international paper, this is again a lesson. Come closer. I promise you do not have to own every stock. I mean, just so happens I think I have because I've got a mind like that, but I didn't own every stock at one moment in time. Over 30 years, I think I've just about touched everything. You don't have to do that. And I was saying to you, we had a big earnings surprise positively for General Motors and Ford, and their prices popped up 10%. And I'm like, do not care. Car companies, it's not obvious that they are. Actually, I don't think it's obvious that they are going concerns. Or they're going concerns which are subsidized by the US government. You should not be in them. And international papers, another one of these. The share price is catastrophically bad. It does nothing. It just goes sideways. And there's a moment with the cycle where it might make you money, but most of the time it goes sideways. Forget it. You got better things to do with your money and your intellect. And yet here I've discussed international paper for 10, 15 minutes. Let's change. I'm pausing. I'm doing acid breath. To change. To change. And I'm looking at a table. I'm thinking, okay, why did I put this table in my notes? Let me read it to you. It's a calendar table. Private sector debt to GDP. 2008. Actually, before I tell you 2008, would you like to know, or would you like to guess? Okay, so you got 3 seconds to get this right. What is the long-term average for private sector debt to GDP? When I say long-term, I'm using data from 1995 to 2024. Okay. Do you want to call a friend or shall I tell you? The long-term average, 100. Do you know, actually, I'm looking at this and I must have copied and pasted. It has 2 decimal points. The long-term average is 132. So 1.3 times GDP. It had a record low of about somewhere between 1.2, 1.3 times the economy, just after the technology, the crash of the year 2000, the technology crash of the year 2000. Right, so let's look at my table. 2008, it was really, really high. It was 172. 2020, it was 158. So we spent over a decade deleveraging. 23, it was 147.5, 148. 2024, 142. So it got squeezed higher initially with the pandemic to 158, and then the private sector continues to deleverage. And so it's what? It's about 10 points above the average. So probably an impetus for further deleveraging. Private sector debt is the thing you've got to worry about. If I sign a contract with you and you put an entry into my bank account, I've got an obligation to you, an obligation to service that debt. And try as I may, this is a Steve Keen joke, but try as I may, I can't print notes to pay you back. And I'm pretty sure my ex-wife is not going to bail me out. So if I have a problem with private debt, my goose is cooked. And if I've got enough private sector debt, of course, then you on the other side, your goose is cooked as well. You're like, oh, bugger. So private sector debt is troublesome. And that record high ratio, 2008, arguably, well, more than arguably, we had a stinker. We had the great financial recession. We have we recovered from it? Yeah, you look at some of those European GDP things, you think, yeah, I'm not sure. I'm not sure. I'm not sure. And the growth rate just has never been the same. It looks as though just owing to a very, very unpleasant period. What did I say previously? Let me read that quote again. Bad times create good people. Good people create good times. So it's like good people, like from the Big Short, and you've got the you got the what did they have? They had like exotic dancers, and the ladies were like buying properties, and the more properties they were buying, that was good times. But then good times create bad people. Who were the bad people? I don't like this bad people thing. Anyway, good times create private sector debt, and private sector debt, if there's too much of it versus vis-a-vis the economy, is bad because it has to be paid back. And if you don't pay it back, remember I was telling you about Queen's County Bancorp, you always paid back because the heavies would come and kneecap you. Maybe I'm making that up, but you get turfed out of your house if you can't pay your mortgage, or you walk out of your house, you're like, hey, again, my goose is cooked, fuck you, kind of thing to the banks. Excuse the F-bomb. That is a long introduction again into this notion. And what's it called? Was I doing clickbait? How long have I been speaking? Almost half an hour. Let's try and wind it up. If I've been doing clickbait, that the title to the show on Wednesday, do government deficits make you rich? And again, so trying to take on some of these concepts and remember what we're saying, only idiots have certainty. And so seeking nuance and trying to, if I got to prepare for this show, I'm trying to teach myself some things. The things you think you know, but you don't know until you go to speak. So what I was saying is a recap. Can I recap? The US government, it spends more than it receives in tax revenues. And that automatically is put money into somebody's account, in somebody's bank account in the majestic 50 odd states of America. Someone's bank account has gone up because the US government has, if you will, overspent vis-a-vis its revenue. And the US government is obliged, and I think the obligation ranges from days to a few weeks, to issue debt, to issue treasuries. And effectively, those banking reserves are brought down and replaced by a private sector asset, which is a holding of a treasury, which is typically in a pension fund scheme. And they're presently residing hypothetically in the asset capital portfolio. We like long duration treasury bonds here, but we're weird like that. But there's that new treasury bond that the pension fund owns. It doesn't represent anyone's liability. in the private sector. So the sheer printing of the deficit has created more assets. So technically, you're wealthier. Now, there's so many pushbacks to that. I think there's I think is it called Ricardian equivalence? I am guessing that from long way back, which would say, because doing that, you're not necessarily gunning or unlike the Chinese printing GDP. I mean, they do it on such a scale that, yeah, they do print GDP with their deficit spending. But what are the Japanese doing right and what are they doing wrong? Because they've had almost immaterial real GDP growth since their stock market peaked in 1989, and they have spent so much more than they have raised in revenue. Their debt to GDP, public sector debt to GDP, is 2.5 times. Now, if that was private sector debt, that'd be an issue. And again, next episode, we should look at the trend in private sector debt in Japan to GDP, because that's the key. Japan's gone from nothing to a lot. It doesn't make any difference. That's kind of the recap of last week. But the Ricardian equivalence, as I try and keep my scrambled thoughts together, the Ricardian equivalence would be, haha, I'm the smart private sector, and you're giving me a new asset, and I have no liabilities in the peer group. However, I'm smart, and this represents a liability, Mr. Government, and a bit like my market-based accounting research. I'm thinking, you don't get me, not so quick. What am I thinking? You've got to repay this debt. It's going to expire. It might be a bill, expire in 3 months' time or 12 months' time. It might be a 30-year security expire, but you will have to repay it. And I'm thinking, you're going to have to raise taxes. And so, you know what? You haven't changed. Maybe you were thinking your deficit financing will change the animal spirits. And you get me feeling all juiced up and ready to spend lots of money building factories, etc. But I see you, and when you come through with your taxes, it's going to kill my final demand. So I'm doing nothing. Maybe there's a bit of that. But of course, the riposte to that is talking about, we don't have to raise taxes. We'll just issue more debt and we'll give you more assets as long as there is spare capacity, productive capacity in the economy. That's the thing that determines. I can put money in, but if there's these swathes of overcapacity, and again, thank you across the Pacific in China, where you have this perpetual sea of overcapacity. You have that overcapacity. You know what? I can theoretically, the I don't want to say good. I'm saying good. The good thing about the mercantilism is you can literally almost sell any amount of treasuries and have a public sector ratio to GDP very, very high without having any bearing. They will buy it. Someone will buy it. Say's law. You supply it. Supply creates its own demand. I don't think it's not. I like quoting Say's law. It doesn't really mean anything. Let me breathe again. But so government spending's out of control and it's going to be inflationary. The money printer. You don't read about it. People just say, oh, they're printing money. Let's discuss the Federal Reserve Act of 1913, 1914 and 1916. where it prohibits the Fed from directly purchasing Treasury securities. Let's discuss the Anti-Deficiency Act of 1870, 1905, and I believe it was amended in 1982. And that forbids any federal agency, including the Treasury, from spending money that wasn't first agreed upon with Congress. And the Treasury must fund all spending through either taxes or borrowing. And then you come into the borrowing, which is authorized by the debt ceiling. So, yeah, is it printing money? Let's say it is printing money, right? But let's see how that works. Again, the deficit means bank deposits have gone up. So the other side of that is bank reserves have gone up. And then within 1 to 3 weeks or so, the Treasury auctions bills and those bank reserves are replaced by bonds. Okay. Now, what we've done there is we've just affected M0, high powered money. The deficit, so this is the printing money allegation, you literally put more money into people's accounts. But by selling the bond, you took the reserve, which the bank has, like your deposit, the money that's come in from the government for you is actually a liability of the private sector bank, but it has this reserve, which is the asset, the reserve of the central bank. But then that reserve gets taken away by the sale of the auction, by the sale of the Treasury. So are you printing money? Not really. But again, it's complicated. The Treasury bill or note or bond resides with the private sector in a pension fund or with a hedge fund or a savings institution. And there's it's a node, and we've got a decision node. Do we just keep this, clip the coupon, and we've got a 60-40 portfolio? We've got equities and we've got bonds. And a lot of that goes on. That money is inert. So there's nothing inflationary about that. On the other side, in this increasingly, the modernity of money, the modernity of the monetary system, innovation is such that there are other institutions that go, wow, actually, I can lend this to other financial organizations and they pay me money. It's a bit like making your stock available, lending your stock for short selling. You don't have any of the price risk. You do it via an exchange. The government backs you, so there's no counterparty risk. But you get paid a fee. And so you got your Treasury yield, plus you're getting this additional income. And you're lending it to people, and then they're going to other people saying, well, hey, listen, I've got treasuries and I want to use it as collateral to borrow money. So now you're printing money. Now you're printing money. You're creating private sector debts. Now, that money largely exists in the financial world because it's like you're using hedge funds and savings accounts are gaining leverage. They're gaining leverage. So they're keeping their money in cash, but then they're taking the assets and they're pledging and saying, I don't want to spend my cash, but I do want to buy Nokia. I do want to buy lithium stocks, etc. And so counterparties are creating money to make that happen. And so we've seen a lot of asset price inflation. God, I do talk a lot. Yeah, can I? I'm asking myself, can I discuss this in a manner which will keep your attention? Or you've got the weekend, I guess. Repo financing. So these fiscal deficits, I think I gave you the numbers the other day. They're like $2 trillion every year for the last 6 years. $12 trillion of treasuries are being issued, and that's collateral into the financial system. And it must be fine. It must be financed. And then you've got the role of the Fed in there. So there's a couple of things going on. So the Treasury's got to issue the bond, and someone's got to buy it, and you've got designated banks that are the only ones that are allowed to buy it. Banks with reserves, swollen reserves, swollen owing to the deficit. And so it sounds automatic. I've got swollen reserves and I'm going to issue bonds. And so we're going to come back into equilibrium and we're taking away the, if you will, the money printer phenomenon. But that's in a perfect idealized world. The life is dirty and complicated. And yes, money has gone up with bank reserves. But some of those banks, not every bank was born equal. And some banks might be having existential crises. And so you can't, they actually, it's just not convenient for them to participate in the Treasury auction right here, right now. Some of those deposits have been, the private sector's like, oh, thank you. And it's drawn down the deposit and it's put it into a money market fund. So it's kind of sterilized it, but it's not available to purchase the treasuries. So the Fed is not allowed to buy treasuries. But it's kind of scheming. You'll tell me, oh, yeah, but they are cheeky buggers. And what they've done is they've gone round the other side, and it's like they're selling cigarettes to school children. And they're selling credit. They're selling credit to the primary dealers. They're like, you got to buy it. I mean, they have to buy them. And the Fed, oh, excuse me, what? Pardon, it's my first sneeze. The Fed has what's called a standing repo facility. And the primary dealer's like, what? I'm just about to receive $1 billion of treasury. And so you can pledge as collateral, not just treasuries, but the treasuries that you're about to just buy. Which kind of sounds fair enough. So that's been going on. And forgive me, I'm just touching upon these things in an erratic manner. I'm just putting it out there, and we can come back and try and finesse these things, and then you can write to me and say you were wrong there, or what did you mean there, and we'll continue a debate. 45 minutes. I might bring this to an end. I said that 15 minutes ago. Quantitative easing, quantitative tightening. The Fed cut interest rates 25 basis points. I'm sure you noticed. The Fed then kind of went, not sure if we're going to do it again, when the market was certain there would be another 25 cut before year end. And the market's like, what? So the markets had to reprice. And at the same time, the Fed has ended its quantitative tightening. So previously, when the treasuries that the Fed owns, when the principal is repaid at the end, that money was being put back into the market to buy more. And then quantitative tightening is like, nah, when we get the money, we're just going to use the expiration of the treasury to run down the size of our balance sheet. So if you will, the Fed. So what was happening there is that they were stopping. They've they've got a 10-year Treasury. They bought it 10 years ago. It's expiring. They're going to receive 10. Let's make it a billion. Going to receive $1 billion in principal back, and that $1 billion previously would have been used to go and buy more bonds. And that's called tightening, because you're in doing so, that $1 billion, hypothetically, I was talking about, you would be competing with the private sector for Treasury collateral. And the collateral that's acquired by the Fed is pulled out and is no longer available for rehypothecation and money creation. And that's why we call it tightening. And the Fed's kind of said, yeah, we're kind of done with that. And partly they're done with it because these repo rates and standing orders or whatever, it's like the post office. But you've been like $1.5 to $2 trillion in issuance. Kind of funky, big numbers, and just a limited number of dealer banks that have to buy $1.5 trillion. And they've all at different points in time got different circumstances. And so the Fed has been having to facilitate and come in and help out. And so it's just like, oh, maybe we should stop with the tightening gig rather. And what I wanted to talk about was, again, QE is inflationary. Yeah? That's what we heard. And my point is, what is my point? QE is maybe inflationary. Sure, I could have made it more contentious, but. So the Fed is allowed to buy treasuries in the secondary market. It just can't buy them when the Treasury is selling them. And theoretically, the Fed could buy all outstanding bonds. And I think I've said this to you before. There's less than $5 trillion. That's like no more than two Bobby Digitals in issuance. So the Fed could buy them out easily, but it would increase money. So it'd be printing money for the non-bank financial sector. So, big question. And I don't think you ever see newspapers talking about this or trying to describe it. And as I career through this, as I slalom down the mountainside too quickly, maybe there's a reason why people don't discuss it, because it's complicated. But QE, the inflationary consequences of quantitative easing, depend on which agency is selling bonds to the Federal Reserve. If the Fed is buying bonds predominantly from the banking sector, that is not inflationary. You are not printing money. If it's sold by non-banks, then you are effectively printing money, because the private sector has $1 billion bond. It sells it, and now it has $1 billion in cash and no bond. Now, it's a bit complicated because the bond, yes, it could use it as collateral, rehypothecate, create money. But in terms of the popular folklore of the Federal Reserve printing money via the private sector banks. It's all about high-powered money is the bank's reserves. And so when, I don't know, Blackstone buy $1 billion. So Blackstone sell $1 billion to the Fed in quantitative easing. Blackstone's bank deposits go up by $1 billion. Their banking counterparties have a liability of $1 billion more. And they don't like that. And so they're going to go and look to make new loans, which are assets for the private sector bank, to the tune of $1 billion. And as they do that, fractional reserves, they might create $100 billion of new money. And then the inflation consequences will depend on the productive slack or lack of which is available. So one of the things that you should have been looking out for, and they've not told you this, is the composition of the sellers of QE. Okay, so there are effectively four. I think Japan's on the 28th iteration. The US is, oh my God, I'm supposed to be at dinner in half an hour. Merde. Japanese, I think, are on the 28th iteration of quantitative easing. It doesn't work. US is on the 4th. So QE1, 2008 to 2010, that was $1.7 trillion of treasuries acquired by the Fed. 60% of the sellers were banks. And that was like helping the banks sort out the mess. Just allowed them, it gave them liquidity. And like, can you take this? Yeah. So not inflationary. Not necessarily, really not necessarily inflationary. QE2 was 2010 to 2011, really short. That was the flip side. That was non-banks, mutual funds, foreign central banks, and the like. QE3, 2012 to 2014, again, 2/3 non-banks. And QE4, the big one, $4.5 trillion, 75% of that was the non-bank sector. So that's how we what did we see? We actually saw a huge surge in, it'd been M0, which then was surged into M2. That's exactly what was happening. It was Fed QE was pushing M2 up. And then everyone went, whoa, look at all that new money. So literally they printed money. But again, in terms of surplus capacity in an international world, there was sufficient room, give or take 12 to 18 months of closing and reopening factories and rerouting shipping lanes, et al. But we found that, yes, we printed a gargantuan amount of money, but there was sufficient slack. And so inflation has been moderating back into the vicinity of between 2 and 3%. So again, just to summarize, the split or the composition of buyer-seller matters in terms of QE. When the Fed buys from non-bank investors, which has pretty much been 2/3 to 75% of the gig since 2011, those new investors receive bank deposits. M2 goes up, expanding broad money supply, more money potentially to chase goods and services, and therefore their prices may go higher. But recent 5-year history has suggested that, again, the phenomenon of China's deep over industrial capacity has kept prices within check. Now, the other point, of course, is more subtle, which is when you replace an asset with cash, when you raise that liquidity in the real economy, you're likely to fuel asset prices higher. If nothing else, because the you've taken duration out of the non-bank sector, and they will seek to replace it, typically with duration stocks. Growth companies have a duration higher than the typical because the majority of the capital return is weighted to the future. So you have a huge dump of new paper money created, M2 swollen. And what do you find? You find the stocks that have done the best, the QE stocks, are kind of bond-like only in the duration profile, right? So interesting. Oh my God, it's gone dark. Dark era. I like this more subtle lighting. Put it back on. The things you miss when you hear me just. Oh, I'm playing with my lamp. I'm back. Estee Lauder. Yeah, I'm a sucker for companies that have been around long time. I've been loved by the market and then lose 90% of their value. Estee Lauder has fallen from just shy of $400 and it got down to about $60. And that's happened over the course of the last 3 years. And they stand accused, I think rightly, of overpaying for acquisitions, over expanding into China, and getting screwed by the Chinese. And just, I think Warren Buffett said, a great business doesn't need great managers. A shitty business really needs the best managers. So this was a good business. Why is it a good business? It's like a drug company. You're selling a dream. It's like, oh, put this lotion or put this perfume on or put this in your hair or put this makeup on your face and you will be as beautiful as me. And your DNA, like with the girls, is like, oh, like we've got to have sex, we've got to have babies, but we've got to push the genes forward. We got to get this. Estee Lauder, we've got girls wanting to fuck. I don't know. Where do I make this up? And then you get retribution. And so this kind of goes back to buy the blip, buy the fuck up. Estee Lauder fucked up. Big time, evidently. And I kind of want to get involved. It's a bit like I was saying to you on my enterprise value to sales. If it's Procter & Gamble and Procter & Gamble is doing 10% margins and it's growing in line with the economy, then I'm probably going to be asked to pay 1.5 times EV to sales. And that's going to give me a long-term return of 10 to 12% nominal. And that probably feels like the cost of the equity, the right level. As a hedge fund or as a speculator, I ain't gonna make that's like I'm impatient. I need to make money quicker than that. And I'm looking for not a 12% return, but a 24, a 36, a 48. And so now I've got to take risk. And so the risk that I like is when you get businesses where how much of a risk is there in Estee Lauder? I don't think great risk. And it's fallen 80%. So that would be rather than paying 1.5 times for the Procter and Gamble, I'm now paying 40% of sales. It makes a 10% margin. I'm turning my capital 2.5 times. So sales divided by the EV to sales, the inverse, I'm multiplying by. Sorry, let me say that again. It was 1.5 times EV to sales. It's fallen 80%, and I'm saying so it's now on 0.3 or 0.4 times revenue. And so there's a formula, it's called the DuPont formula. Look it up. But in shorthand, my return, if I buy the stock, my expected return, not my actual return, my expected return becomes the 10% recurring EBIT margin that I imagine will continue in perpetuity. But I'm buying it at 0.3 times revenue. And so my return is going to be more like 30%. And so I'm willing to speculate and be a monkey and try and pick bottoms. Now, the risk that I run is twofold. The EV sales function here is still not great. I think it's like, what did I say it was? I took notes. Yeah, the enterprise value is 40 yards, 40 billion. They've got about 5 billion of net debt. And they're doing revenues of 14. So, yeah, it's almost 3 times sales. And they're not making any money just now, but let's say they go back to making 20%. 20 divided by 3 now is like 7. And then what's my long-term growth rate from Estee Lauder? 6. I'm back at 12. So maybe I'm wrong. Maybe the EBIT margins could be more like 30, 35%. Or maybe I'm just too early and this will be a Nokia and we'll come back to this in 20 years' time and it'll be still at these levels and it'll have grown into its valuation. However, I was talking to a great friend, Tony. What's Tony's? Uncle Tony. Uncle Tony. What is Uncle Tony on the Twitter? I will put that in the notes. And I was like, Uncle Tony, what can I do with options here? I want to take a 10 grand. I want to be long 10 grand in Estee Lauder. I think, yeah, it's become less risky given the gargantuan price fall. And Tony, I love Tony. He knows more about options than just about anyone I know, except for Trader Mike. And he's like, and he talks a strange language. He's like, oh, I love this. Let's do a zebra along, like a zebra. What the hell is a zebra? And he's like, it's zero extrinsic value. I'm like, I have no idea what you're talking about. So let me try and explain. And thank you, Tony, for doing this. So he goes, but how far out does he go? Yeah, he goes out to April expiring contracts in 2026. I asked him to go longer, but to go longer out, but Tony, options. So he's out in April and he's buying 3 units. He's buying 2 $80 calls and he's shorting 1 100 call. And the price today is towards the upper range of that 80 to 100, kind of like with a 9 handle. So he's selling 2 calls and he's well in the money on them. And he's selling 1 call at 100. That's where you get this zebra, extrinsic value. Extrinsic, so intrinsic is where it's in the money. In the money, I bought a TLT call option at 80 and it's trading 90. I'm 10 points of it intrinsic. Yeah, and that's going to be reflected in the price. Extrinsic is where it might trade. The extrinsic would be trying to capture the optionality of Estee Lauder by April next year might be trading at 120. It might be trading at 60. That's the extrinsic magic, which is typically overvalued. And so when you're buying calls, you're impregnated with something which is overvalued. And so it's always good to sell something, sell an option and sell something which is overvalued. And that's by combining the 2 longs at 80 and selling the one at 100. You've cheapened the option. And those 3 units is like your 10,000 cost. So I've got a 10,000 cost, but actually the way with the deltas and the options and leverage, it's really, I've synthetically created a position which is 30,000. So if it works, I'm 3 times leverage. Now, if it doesn't work, and this is the drawdown, and this is a really stinky drawdown, I lose the 10K. So with this strategy, and would I do it? Am I recommending this? I'm not recommending this. But again, I'm like trying to pull up the bonnet, trying to look at trades, trying to think about things, pros and against. I like the Estee Lauder chart. I don't like buying it because it could be here for a long, long time. My gut, I don't like the valuation, but my gut says, and the Fed's going to be back doing QE and leveraging, and every dog has its day, and this is a good business. And. So I've got one strategy. I put 10K and I buy it, Estee Lauder. Estee Lauder will not go bust between now and April of next year. I'm willing to go on record as saying that. So the worst case is Estee Lauder have another profit warning. That's a big risk. And the stock might fall like International Paper, 12% on the day. That's a big risk. But, big deal. I lose $1,500. On the other side, maybe it exceeds estimates and it goes and trades at 120, and it's like, big deal. I only had 10,000. Yeah, I've only made $2,000. So symmetry. I could lose 1,500, 2,000. I could make 22,000, or I can risk losing it all. Or if it does go to 120, 130, 140, I make not 3,000, I make 10,000. So I make twice the money I'd make, twice the money, my stake money on the equity. And at the same time, that max loss, I can work on that by, in the short term, I could be selling more weekly expiring options just to reduce my total investment. So, don't know. The strategy mimics stock ownership. I don't have to worry about it. There's no time decay. Every day I write the book. There's some strategies that every day that you're not making money, that book is going to be killing you. So I don't fear it going sideways. But I do fear, being long the 6 calls, being short the 3. I do fear my net investment going to zero. But, we review that in a month's time, etc. And that's a manageable risk. It's not a gap risk. So that is Estee Lauder. Capturing directional upside. But boarding the Estee Lauder is not cheaper than I thought it would be. Anyway, I'm just thinking to myself, and for me now, it is 9 minutes to 9, and I've got to get ready and go and entertain Mr. George Gammon. It's the weekend. I've said a lot. I don't know. I wish I'd said it better. I have regrets. I have a few. Whatever. I'm going to have a great weekend. Thank you all. I am Hugh Hendry. I am the Asset Capitalist. I'm signing off from St. Bart's. I will be on Twitter. I will be on Instagram at Hugh Hendry Official. I'll mute that the filter we're using is making me look old. It's killing me. But I will be on Twitter and of course Substack, Patreon, charts, debate, more to come. Thank you all. Have a wonderful time. Good night. Goodbye from St. Bart's.